I've always had this theory that the markets were contrived, that they were fake. So now I've been putting that to the test. I'm actually at this time paying to be mentored to learn more about the technical analysis, to learn more about the stock market, about options, about all the intricacies. I am absolutely knee deep in this stuff right now. And I want you to know what I found so far. This information right here is not for everybody. This right now is simply just a theory. I'm going to look at some of the things today that I want you to see. Okay, so let's begin with this. We have to understand 80% of the daily volume in the US is done by machines. So what you get is a lack of focus on earnings, a lack of focus on outlooks, and you just get the short-term movements based on very specific data that is released every day that creates noise. This is a fact that the computer algorithms move the market. Now, sure, the long term, you could say, okay, over the last 20 years, this is the way it goes and so on. I'm talking about the ebbs and flows of the market. We will look at the charts in just a second. You can see where the money is moving to and from. EPFR, which is something that I show you all the time. This institution basically tracks everything, where the money is moving into different countries, into different assets, into different stocks. They have that all. They give away some information for free, but of course there is a paid tier. Now, if we look at this data, we can have a good idea as to what's happening. We can use things like the put-call ratio. How many people are betting that this is going to go up or it's going to go down? And we can look at that. We can look at all these different indicators to give us a little bit of insight as to what's going on in the markets underneath the hood, instead of just looking at the S&P 500. Okay, I'm just going to look at the S&P 500. What's the price today? What was it yesterday? Okay, it's gone down, it's gone up, and so on. There's another level to this, and I'm going to show you some stuff, okay? I brought this up right here. What you're looking at are the broad markets, the four broad markets in the US: S&P 500, Dow Jones, the NASDAQ, and the Russell. All right, looks like a big mess. Okay, so let's simplify it a little more. And if anybody has left the video so far, I assure you this wasn't for them. All right, a lot of stuff, right? So let's focus on this middle section here. I hope you can see my mouse. I've written down a bunch of things that I want to cover. So you're seeing the little bars in here, okay? And I'm going to do videos about what all the bars mean exactly and all the things. But just for the topic of the video, this contrived nature of the markets, stick with me, okay? I'm just going to give you the basics. So that's, of course, the price, the current price. And I'm looking specifically at the SPY, or the S&P 500 ETF. And so you could see that it moves up and down. The general direction going back, I mean, I'm showing you essentially from May, but we can go as far back as you want. The general direction has been up. You see that. Oh, okay, fine. But what happens along the way? The market goes up, it goes down, it bounces around. And I have been noting I've been paying a lot of attention to this. And like I said, I'm paying money to learn it, not just observing, the geometry, which is one aspect of it, but actually paying to learn it. Now look at what happens here. Okay, you see these purple lines? It's called a Bollinger Band. And the way it was described to me was essentially that, imagine this is the area in which there's oxygen, and the stocks cannot live outside of that oxygenated environment for too long. You notice the way it goes, right? If it ever falls out of that Bollinger Band on the top side or the bottom side, it tends to find its way back in, doesn't it? Interesting. Okay. So that's not perfect, of course. You can't bet just on that, of course. Most people, though, they look at this information and they say, this is way too much. I'm just going to go long, and here we go. But what if the market was a little bit more predictable than we thought? And what I propose to you, just to lay it out, is that because of the way that the computer algorithms are in this market by far more than humans, that we have more predictable markets in the short term. Now, you could have, or I should say medium term, you could have an event, China does something here, somebody sends a tweet there, and suddenly markets come down or markets shoot up. But they tend to be within a certain range, no matter what happens. Okay, let's take a look. All right. I did a video right here. All right, let me get rid of this here. Okay, just look at the Bollinger Bands for now. We hit the bottom Bollinger Band on the S&P through this period, and that was on December 20th. And I did a video and I said, look at what's happening. This looks like it's going to bounce higher. I actually made a video specifically because it was so obvious to me. And then we get to the top of the Bollinger Band, and I did a post on the community or blog section of the channel. And I said, it's looking toppy. I'm just paraphrasing. It's looking toppy. Maybe not much more room to go, something like that. Why did I say that? Just because of the Bollinger Bands? No, because there were other indicators at the same time. Despite the fact that we were in the Santa rally. So you had the news on one end saying Santa rally, saying huge inflows, saying everything's looking good, saying the thing that's going around, it's not going to be as bad as we thought it was. All that stuff is positive. Unemployment super low. Why wouldn't the stock market just keep going higher and higher and higher and higher every day? Because these computers are playing along with these different indicators. That's my hypothesis. Now we have the moving averages. Look at this moving average. This right here. So the top one is a 20-day moving average, the red line. And this, orange-brown line here is the 50-day and the 100-day moving average. We bounced down to this 100-day moving average at the same time hitting the bottom Bollinger Band. That gave me the insight to say, it looks like we're going higher. At the same time, this up here is the StochRSI. I know. Just hang in there with me, okay? This StochRSI kind of gives us the momentum. Think of it like that, momentum. It goes from this line right here, if you could see it, that's 20, and up here is 80. And so it goes from overbought to oversold, overbought to oversold. It just keeps oscillating between these two levels. So we had previously, December 1st, already got to the point of oversold. So the next level it's going to get to, overbought, hadn't happened yet. So we were technically still on this move upward. That's where I got this as well. At the same time, we had actually the next day on the 21st, we had the RSI level at the bottom of the page here. RSI, another oscillator going over 50. Now I know you're probably thinking, what is this all this mumbo jumbo? What's he saying? This is not important and so on. What I'm saying to you is that what we see is not what it appears. And I'm talking, this to me is a huge revelation. Okay, and I don't want to go on too long. If you're interested in more, let me know. At the same time, we can look at the volume, because remember what I said about the EPFR. Now the EPFR shows us where the money's going to and from and so on. And we could see the volume and see what's happening in any individual stock. And you could look, oh, the money's going out of tech stocks right now. But of course, it's got to move somewhere. Where is it that it's moving? We find it, and of course, we could see those patterns. It's not disappearing, it's moving somewhere. At the same time, we have the month, quarter, and year end. Things kind of get some ways more predictable, some ways iffy. If you look at earnings, nobody wants to hold through earnings because it can be volatile. Even though they might be totally great, the market might just react in that way. Same with month end, quarter end, and year end. Sometimes these pension funds or what have you, they need to sell. They need to get rid of their equity positions. Sometimes they need to buy. All of these things are interconnected. And then we have news is noise. Because you can get some news that comes out, jobs report, 3 months in a row, the jobs report comes out. It shows beating estimates. Everything is great. Market goes up. But then the fourth month, you see the same situation, beating the estimates, and then the market goes down. And you think to yourself, 3 times in a row, why didn't the market go up? Because it's about the patterns, not about the noise. Do you see? And then we have these odd patterns that form interconnected with that. Why is that the case when you get all this good news and then the stocks still come down? Again, back to what I'm saying. I believe it's more contrived than we think. It's not just the Federal Reserve printing money, pushing the markets up to new highs. No. Why is it ebbing and flowing the way it does? Why does it stop at certain points? All of this, in my opinion, is done based on the computer algorithms and the way they trade. So it is my theory that this is more predictable than we've made it out to be. I'm not saying that you can go and pinpoint every little thing. Not at all. But what I am saying seems a little unusual, seems a little fishy, but some people, though, they are able to profit from it all. Okay, that's all I'm saying. If you want more detail, if you want more information, I have been asked many times before to basically cover this, to talk about this, to make videos about this, to explain what all the bars are, what all the lines are, all these different things. And I'm willing to do that. The channel's views have gone down. All the likes have gone down. Subscribers have really stagnated over the last while. And so I'm open to hear from you and so on. I hope you appreciated this information. If you do, please just hit that thumbs up to support the channel. And that's it. Take care.